I accept the era of free money is over and the Fed will be draining liquidity to bring down inflation. I accept that rising rates mean lower stock valuations. And I accept that globalization is likely over. And finally, I accept that I've made mistakes underestimating all of the above. Here's what I don't accept. I don't accept there isn't anything we can do about it. Stick around. This is what I'm doing. Welcome to The Money Runner. I'm David Nelson. The S&P 500 is down 24% this year, and at the very least, much of the valuation correction is behind us. But on a historical basis, we're still not cheap. And each stair step higher in rates makes it a little more expensive. However, there are stocks trading at reasonable values and do meet that criteria. The bummer surrounding value stocks is that they're often boring. Growth stocks are sexy. They're about the future. There's nothing sexy about a bank, a stodgy industrial company, or a natural gas stock. We sometimes forget just what a stock represents. It's a contract between you and the company. It entitles you to your pro rata share of the earnings and or dividends of that company. Broadly speaking, what's happening at the individual security level really matters less than the big picture. At minus 23.9% this year, the S&P 500 is in a bear market, but large cap growth down 32%. If you were focused on value, it hasn't been a great year, but you're not in a bear market, down about 16%. Lousy, but down less than half of what growth is. This is where a little history is important. The last great drawdown in growth stocks was coming out of the dot-com bust. It's understandable. Coming out of that bubble, growth would underperform value. The difference was staggering. Value was up close to 25%, while growth was down 24% over the next 8 years. What about if we measure it from the bottom? Well, the bottom occurred in October of 2002 as we were gearing up for the war. But even here, value outperformed by a wide margin. So why this mad passion for growth stocks? Well, this chart is your answer. Coming out of the financial crisis, value and growth performed closely to each other. But something happened in 2014. Market participants became convinced that the Fed was going to keep rates lower for longer, the opposite of today's conditions. There was a brief scare in 2018 when Fed funds hit 2.5% and 10-year yields hit 3%. Markets struggled in the fourth quarter of that year, but recovered in early 2019 when Jay Powell blinked, hinting the Fed was done with its hiking cycle, and in fact started cutting later that year. COVID and what followed is history, and the Fed did the only thing they could, following a near complete shutdown of the world economy. From 2014 to 2021, growth was the only path to success. By the close of last year, the spread in performance was a massive 155%. All right, let's be clear. That isn't happening again anytime soon. Markets will eventually recover, but it won't be a drunken liquidity party on the other side. Investors will have to have religion. Profits, cash flow, and dividends will have a seat at the table. Revenue growth on its own, not going to cut it. Some growth stocks will actually turn into value stocks. That's already happening. There will be increased focus on profitability, margins, and returning capital to shareholders. We've had a few periods this year when growth made a big surge back. Coming off the June bottom, growth outperformed value by a wide margin. Unfortunately, I only got half that trade correct. I recognized there was a shift underway, but held on to the growth stocks I bought way too long and watched profits turn into losses. Moving forward, we can't stretch on valuation, and the terminal rate for Fed funds will be an important metric to monitor. The hot prints in both the CPI and PPI last week lock in another 75 basis point hike in November. The Fed's timing has been less than ideal. A late start likely leads to a late exit and the consequences that go with it. A recession is likely before we get out of this, and that may not be our biggest danger. Central banks around the world have been at zero and sometimes negative rates for years. Unwinding this will have unintended consequences. What's happening in Great Britain right now is a warning sign. The Bank of England was forced to go into the open market and support the 30-year gilt. That's the equivalent of our 30-year treasury. And Britain's new prime minister was forced to do a 180-degree reversal as markets reacted violently to an unfunded stimulus. If we're not careful, something similar is going to happen here. We covered a lot of ground today. It's going to have to be some follow-up. But if you like today's pod, hit subscribe. Again, comments are welcome, and I'll get back to you as soon as I can. Thanks for joining. I'm David Nelson.